Michael Burry is such a focus point of The Big Short that we often forget the other important investors who were also involved in betting against the housing market in 2007. Danny Moses, depicted by Rafe Spall, is the founder of Moses Ventures and is famous for being Steve Eisman's head trader during the global financial crisis, and together made a huge amount of money shorting worthless mortgage-backed securities held by the banking sector. Today, Moses was on CNBC to share his prediction for what's to come in what he calls a deteriorating economy. This comes as the Federal Reserve in the US continues to raise interest rates in the face of worsening financial conditions and essentially promising to back all US deposits, which could have some severe unintended consequences according to Moses. All of this and more in today's video, and if you'd like to help me reach my goal of 200,000 subscribers by the end of the year, then the best thing you can do is go below this video and hit that little subscribe button. If you can do that, I'd really appreciate it. But with that said, let's get into the video. Whenever an industry or a sector is going through some kind of short-term problem, investors are rightly curious about whether that's a place to look for investment opportunities. After all, one of the best ways you can buy a great business at a low price is to look in areas that are going through short-term pain and potentially where there may be mispricings of great businesses being sucked down with the broader industry. So is the banking sector a good place to look right now, given the problems we've seen at some of the regional banks in the United States?
Taking it all in here, a lot has gone on, obviously, in the last week. A week ago, no one even knew, or some people knew this might happen, but this kind of new. So it's hard to really buy or sell securities, or stocks that is, not knowing how the plan's going to be unveiled, and we're getting a little bit more clarity on that. The problem here, though, is really sifting through. It's not just about agency securities and treasuries. There's commercial loans that are on banks' balance sheets, commercial real estate, right, C&I loans, et cetera, that are still going to be a problem. And I think now's the time to really dig in to these banks.
Moses, like Steve Eisman, doesn't see anything promising in the banking sector simply because there's a lot of unknowns about the situation. Are there other banks in the sector that are exposed to similar risks? Will the Fed continue to back deposits as more banks fail? And how will regulations change after all of this pans out? These are some of the many unknowns around the banking system, which makes the whole investment area very difficult at the moment. So especially if banking isn't an area that you understand well, then certainly don't feel the need to rush in and invest in the space. While we don't know what will happen for sure in the short term, the tighter credit conditions coming from this banking crisis are likely to cause economic pain more broadly across the economy. On Thursday, Jerome Powell, head of the Federal Reserve, said they believe events in the banking sector over the past 2 weeks are likely to result in tighter credit conditions for businesses and households, which in turn will affect economic outcomes. It is too soon to determine the extent of these effects and therefore too soon to tell how monetary policy should respond. So this speaks even more volume to the idea of being patient and waiting for opportunities to present themselves in areas that you do understand. That Federal Reserve press conference comes after the monthly FOMC meeting where the Fed decided on its changes for monetary policy. This time, the Federal Reserve decided to raise interest rates another 25 basis points, bringing it to a range of 4.75% to 5%, indicating that they still see inflation as a bigger threat to the economy than the unfolding banking crisis. At the press conference, Jerome Powell referred to the banking failures as isolated banking problems and that the banking system is sound and resilient with strong capital and liquidity. But they are certainly concerned about the banking issues spreading across the economy because they did decide to backstop all of SVB and Signature Bank's deposits, an unprecedented move which begs the question, are all bank deposits now fully backed by the Fed? Powell's answer to this was, I'm not saying anything more than I'm saying. You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or the financial system, and we're prepared to use those tools. I think depositors should assume that their deposits are safe.
In terms of, though, guaranteeing all deposits, does that make anything safer in your view if this became the norm, if this became the rule, that there is a backstop for everything? Does that make the sector any more attractive in your view?
No, I think that should scare people, the fact that the regulators think that they need to go out and actually do that. And so now I think what we're going to see is the banks that maybe come to this window and use this program is going to raise a lot of questions. And you can't assume that the regulators have any idea what they're actually dealing with now, considering that they were completely caught off guard, it appears, by what just happened at Silicon Valley Bank. So that should make people nervous.
The Fed seems to be hoping that if they tell people all deposits are safe, that it'll prevent panic from leading to the Fed actually needing to back all deposits. But it doesn't bring a whole lot of confidence into the financial system.
We're definitely not out of the woods, and I think the Fed is kidding themselves if they think that this situation is just going to go away. I think a lot more people will come to this new window, so to speak, to deliver some of these assets.
In addition to backing the deposits of SVB and Signature, the Fed and Treasury created a new program called Bank Term Funding, which allows banks to borrow money against their assets if they need liquidity. And while it's a good idea in theory, which helps with the interest rate problem we've seen at banks like SVB, it could also lead to more panic. Will people get spooked if they see that their bank is going to the Fed to get additional liquidity? Or will people feel safe that even though their bank is going to get liquidity, they have access to it, so there's nothing to worry about? Only time will tell how all of this plays out. What we do know is that the Fed is continuing to raise rates as it sees inflation as being the larger issue.
You know, the saying is the Fed keeps going until something breaks. Was this it?
This was a small vase sitting on the window. So again, you know, what I really think is in terms of breaking, obviously this wasn't on a lot of people's bingo cards, right? It was on certain people that have been actively shorting some of these names that saw this balance sheet that had massive issues. So I just really feel like we still have underestimated in this market in general what is happening when you raise rates 4.5% and what may end up being 5%.
Changes take a long time to emerge in economics, and Moses thinks we still haven't seen the full effects of interest rate hikes. This banking crisis we've seen over the past couple of weeks is certainly one of the results of rapidly rising interest rates over the past 12 months, but there could also be other problems that we haven't seen yet. Finally, Danny Moses gave his predictions for the economy throughout 2023, including a discussion around the huge economic dilemma that the Fed currently faces.
We got the relief rally associated with the Fed stopping, but the truth is the aftermath of this, I think actually the economy, if you believe it's going to slow down, it just accelerated that slowdown because banks have to really pull back in their activities.
Moses is suggesting that the Fed rate hikes were already likely slowing the economy as the cost to borrow money has increased substantially, and that reduces business investment and consumer spending. But now with this banking crisis, banks are also being a lot more careful about how they lend out money, so the slowdown in economic activity has likely accelerated in the past few weeks.
And the other thing, Melissa, is this whole QT, quantitative tightening that's been going on. Great job. We got it down from 9 trillion to 8.4 trillion. I think we can safely say that QE or that QT is probably done here, and we're back in somewhat of a QE, at least a neutral mode. So we got some stuff done, but the problem here is we still have inflation. And I believe that you are now brought forward the potential for stagflation as a result, because the Fed still has to do their job, because what you don't want to see is them to stop while inflation is still running hot.
The dilemma the Fed faces is a choice between financial stability and price stability. Do they continue to fight inflation by raising interest rates and ultimately making a weaker economy? Or do they support the economy by not raising rates or even lowering rates, but then risk another surge of inflation? This is a very tough choice, and it's exactly why it's so important for the Fed to try and stamp out inflation as quickly as possible. If they can get inflation under control, then the Fed will have the tools available to help the economy if it eventually faces more pain. On the other hand, if inflation is still running too hot when the US goes into a recession, then the Fed may have to wait before they're able to support the economy by lowering interest rates. And this isn't just a problem in the US. The UK just reported an accelerating rate of inflation of 10.4%. And while the UK isn't technically in a recession at the moment, the UK government and central bank are currently facing a lot of difficult choices about how they provide stimulus to people in their difficult economy, and how do they manage that while also trying to tighten the economy to reduce inflation. I'm going to be continuing to cover the banking crisis and any other adjacent issues and problems in the economy that are happening over the next few weeks. So if you want to be up to date with those things, then the best thing you can do is go below this video and hit that subscribe button. And if you want to be notified when new videos come out to your phone through notifications, then just hit the little bell icon and you can select which types of notifications you would like. But with that said, hope you guys enjoyed this video. I'll see you in the next one.